Good morning, everybody, and welcome again to this seminar, one of a series that Goodwill are running, covering a range of different areas. Some quick introductions. So I'm Kevin Rutter. I'm CEO here at Goodwill. I'm joined today by Lisa Thomas, who is our payroll manager, running that team and delivering to many clients in that area, and supported by Kate Brennan, a manager from our finance team. A little bit about Goodwill before we dive into the areas we'll be covering today. So here at Goodwill, we've been supporting international businesses seeking to expand to the UK market for over 25 years now. We focus entirely on inbounds into the UK market, delivering a range of non-core outsourced business services covering 5 areas. They are, in no particular order, finance, so a fully outsourced finance function; HR, full employee life cycle around HR and related matters; governance and risk and company secretarial, so filings, regulatory matters, agreements, that sort of thing. Front of house and virtual office, which gives a low cost option for businesses not ready to have their own space, but they have an address and admin matters can be dealt with there. And last but not least, and the focus of today, is payroll. So moving on to the things we'll be touching on today. Payroll sounds quite simple in many ways, and many years ago it arguably was. You agree what you're going to pay your people, you process that through a payroll system. It used to be manual; it's now all computerized, of course, and tax calculations are made, deductions and payments made to your employees, and tax to the authorities. Nancy, can you mute? Somebody's coming through on the sound. I'm getting an echo in my ear. Can we pause?
Uh, Might be Kate. I'll just mute you.
Let me keep going. Apologies, everyone. So, but payroll's changed a lot in recent years. In fact, 10 or even 20 years now. It seems to have become the mechanism for dealing with a whole load of regulatory matters. So, of course, tax relating to the employment income of the people concerned and national insurance. But now we have things in there like student loan deductions, taxing of benefits in kind, and a whole range of other things, court orders, fines, that sort of thing. What I hope to do today is give you an overview of the basics around the process, and some of it might be obvious, but not necessarily to everybody. The fundamentals about income tax and how that then applies to an employee payroll scenario. We'll then drift into benefits in kind. So by that, we are talking about things where non-cash items are given to employees as a consequence of their employment, but they are taxed on them, cars and the like. PAYE settlement agreements, that relates to benefits, but small things that can't be taxed on the individual will cover that. A summary of what employee costs look like in the UK with some of the add-ons that all employers have to cover for their people. And finally, at the end, a small number of real practical things that we see causing confusion between ourselves as a payroll bureau in this space and some of our clients and their employees. And there'll be a Q&A session too. So moving on from there. So first of all, what are the basics? Well, to employ people and pay the relevant taxes and so on, each employer needs to register with the tax authorities, HMRC. And a PAYE stands for Pay As You Earn registration is required to do that, to make sure that's done in a compliant way. That can take some time. I've put 6 weeks there. It can be more, it can be less, but it's actually quite important to get that in place before people start to be employed. I will touch on that again at the end. So at its simplest, pretty straightforward, right? What do? You record your employees' pay in the system. The system largely calculates the deductions, and we'll go into those in turn for the main areas that relate to that. It calculates social security costs that need to be paid by the employer for employing those people. Payslips are produced, and there's a requirement that those are produced and issued to all employees with certain defined content on a monthly basis. And then finally, on a monthly basis, there's a requirement for the payroll run to be submitted with relevant details of tax, national insurance, and so on to be delivered to HMRC. That's done online automatically when the payroll period is closed. Each employer has an online account, so they can actually go on and see what is due. and payment for the previous month's deductions and employer costs has to be made by the 22nd of the month following, and there are penalties if that is not done. So that's the basic high-level process, which sounds quite simple. So where does it get complicated? Well, let's move to thinking a little bit about, again, fairly basic question: what is pay? At its simplest, all the stuff we know and love: salary, bonus, commission, statutory payments. So if we just move to the next part on that slide, Nancy. So statutory payments are required by law to be paid under certain circumstances. All of them are set out there. Sick pay and three different types of pay to do with children, whether it be maternity, paternity, or adoption pay. All of those are also taxable, and they form part of the cost of employment where it is borne by the employee to pay those things. Of those shown on the screen right now, SSP statutory sick pay is paid by the employer and is a cost. Most of the others are covered in large degree by the government. Not fully, but typically 92% for most companies of a certain size. So not really a cost. Quick comment on that. Whilst they're the basics in terms of statutory payments to employees, it is normal and best practice for employers to be more generous than that and pay over and above. In those cases, that is clearly taxable and is a cost to the employer. So that constitutes pay, and we'll get to benefits in kind as well shortly. So deductions. Actually, we're talking here about not just deductions from your employee's pay to be remitted to the authorities. We will also cover costs of the employer that are attached to employing people. What are the main ones there? Income tax, clearly. National insurance contributions or social security costs. Student loans, which I mentioned in passing a few minutes ago, and pension. There are others too, which I will mention as we go through. So moving into income tax. So it's straightforward if somebody is employed and that's their only source of income. Where it can get messy, and this will come up when I talk about how it's calculated through payroll, is where there are multiple sources of income. And when we're talking about running the payroll, that is only one source, and tax has to be calculated there, which may be trying to calculate tax on other sources of income through certain adjustments made. I'll get to that in a second. The table there now, though, is what applies in the UK right now for the current tax year in terms of the tax bands. So income is banded, taxable income is banded, and then taxed at either 0, 20, 40, or 45%. And you will see that the first row on there, the personal allowance or tax-free pay, is taxed at 0%. Note, however, that does diminish to zero where taxable income is over 125,140, which effectively means it reduces by £1 for every £2 of taxable income over 100,000. You probably all know this, but a quirky fact: the tax year runs from the 6th of April to the 5th of April. Antiquated, been in place for hundreds of years. Doesn't really cause a problem, but a little bit quirky. Yeah, touching back on one of the complicating factors for payroll that can cause confusion. When it's run through the payroll and calculated cleanly, nice and simple, but what about other sources of income? You get into then the need sometimes for self-assessment returns to be submitted by people, and they are required where income is over 100k, or the government request that takes place. And things are starting to get a little bit mixed up there. It's not just what the employer is paying; other things are in the mix, which may be being taxed through the payroll process. Okay, moving on from there and how that actually cranks through in a payroll run perspective. And one of the first problems actually that we see as a payroll bureau is this whole thing about a tax code. Now, a tax code is effectively an instruction by the tax authorities to calculate pay for an individual in a certain way. Essentially, it's really adjusting how much tax-free pay they get, or saying they should be taxed on more or less for a range of reasons. I'll touch on those in a second. That's automatic. That's downloaded by HMRC into the payroll software. At its simplest, for somebody who is earning less than 100k and doesn't have any adjustments to their income from other sources of income or benefits in kind being taxed through the payroll, the code will be 1257L, which gives them their full tax-free pay. Nice and simple. What causes confusion, though, is where an individual, in our case, an employee of one of our clients, has a tax code which is non-standard. They perhaps don't understand it. It might actually be wrong. HMRC has given them the wrong code. That can cause a lot of confusion. I think a key point here is that that can only be resolved between the employee, I'd have to do it for myself, and the tax authorities directly. It's a matter between those two parties, not the person running the payroll. Other things, though, that can adjust that tax code to make it a little bit more complicated. Taxing of benefits in kind, non-cash payments, which need to be taxed. And we will get to more data on this in a second, but typically they are captured as part of an annual return process. The tax code is adjusted so that they can then be collected through the year. However, if benefits are added or taken away and the authorities are not informed, the tax code is then effectively wrong for a period. Other sources of income I've touched on, they can be adjusted for the tax code to collect it through payroll runs, and things like trying to catch up on tax for previous years as well. Everybody sees their tax code and every individual has a tax account with the authority. So I think it's important that employees actually look at and understand what they have. Okay, next one, national insurance contributions. So social security costs. In addition to tax deducted from employees, national insurance is also deducted from employees. There are two quite large tables there, but as its simplest, for the vast majority of people, employee national insurance, the amount deducted before net pay is paid, is 10% of the amount above the primary threshold. That's the first row shaded in a nice pink colour there. So per annum, £12,570. And the rate attached to that is 10% up to the upper earnings limit, which is the bottom number, 50 to 70. At that point, anything above that reduces to 2%. As the tables show, lots of other categories, but they depend on people's individual circumstances. The vast majority of people fall into those. So there's two things so far. There's the tax deduction in accordance with those bands and rates. There's the employee's national insurance deduction as well. And both of those are remitted as part of that payment due by the 22nd of the month following. In addition to those national insurance contributions deducted from the employee, there are costs paid by the employer. So this table is showing the employer cost, not a deduction from somebody's pay, but an on cost that has to be paid. Again, quite a number of bands on there, but for the vast majority of people, there are numerous special cases, the employer pays 13.8% on income over and above £9,100 per annum. Both are aggregated together. Both are remitted to HMRC with any tax and other relevant deductions on the 22nd of the month, as I said before. So all of that wraps up quite neatly together. Student loans. I mean, one of the first, it's been around for a long time now, but one of numerous examples of additional complexity into the payroll system, where the government seem to be using payroll and the payroll process as their core mechanism for dealing with all sorts of different things. Pretty obvious to most people, but perhaps if you're new to this country or not aware, what in essence happens in the UK for tertiary or university education is that loans can be sought by students to cover tuition and some living related fees. They can very clearly become very significant over a 3 or more year period. They are given by the student loan company, effectively a government body, and then they are repaid as and when those people are in employment earning above a certain amount of income. The different plans are in essence different time periods when people finish their studies and took out their loans. But broadly, once a salary is above mid-20s or thereabouts per annum, 9% of that excess is repaid back to the student loan company to repay that loan. And that goes through the payroll, and that's paid of the remittance each month as well. An important fact to note, it's a long-term thing, but loans not repaid. So first of all, if people don't earn the right number, they don't repay. And after 25 or 30 years, depending on the plan, they vary slightly, any outstanding amount is written off. They can be quite significant amounts. So that's another set of deductions that have to be processed through payroll. The basis for those, i.e. which plan people are on, is something that has to be captured when somebody first joins a company. They have to inform their employer which plan type they're on, which drives the basis of deduction. However, if that's missed or is wrong, typically HMRC will do what they do for tax codes and send an instruction by downloading a code to the software to be used in subsequent months. So that's student loans.
Sorry, can I just highlight a point on there as well? Something we probably should have put on the slides, but it's just come to mind with me. When student loan deductions are made, it is not just on base salary. So if at one point in the year an employee gets a bonus or a commission payment, the student loan is also taken from that payment. It's not just base salary.
Okay, so it's all income.
Yeah.
All right, thanks, Lisa. Pension schemes. Another complicating factor that's landed on payroll teams in the past 10 or so years. So relatively recently, the government introduced the requirement for all employees to put in place a workplace pension scheme. Every employer has to have a scheme. That's mandatory. They may not have anybody in it, but they have to have the scheme. In terms of people joining it, most people are auto-enrolled. There is no choice. Somebody joins employment with the company. That company has to have that scheme. People are automatically joined and the appropriate rates applied. The individuals can themselves choose to opt out, however. That's fine. They will be re-enrolled. I think it's every 3 years, but they can opt out if they want to. It says most there because it only applies to people between 22 and state pension age earning over 10K. So anybody not matching that criteria won't be auto-enrolled, but they can choose to be enrolled into that scheme. In terms of the contribution requirements, and this can get very, very complex, the whole pension thing, but the basic level is that the minimum overall contributions, so by overall, I mean how much of the salary of it is paid by the employee, so a deduction from their pay, and how much is paid by the employer, so an additional cost of employing that person. In aggregate, that is a minimum of 8%, of which the minimum to be paid by the employer is 3%. So if it was 3%, then the minimum by the employee would have to be 5 to make the 8. But if the employer paid more, the employee could pay less, for example. Both could pay more if they want to. The next question is what that applied to. What is pay relevant to those contributions? There are two main bases that applies to. Firstly, basic salary, which I think is pretty obvious what it says on the tin, what somebody's agreed salary is, but not bonus on top of that, hence the basic. And then qualifying earnings, and many schemes still operate on a qualifying earnings basis. Qualifying earnings means that those percentages are only applied where somebody's salary is above a certain value and below a certain value. The range currently is between £6,240 and £50,270. So somebody earning more than £52.70 on a qualifying earnings basis scheme, no more pension contributions will be paid, and somebody earning less than £6,240, no contributions would be paid. It's the bit in the middle. Well, that's all that it applies to. In terms of payments for pensions, that is typically a case, and every scheme is different depending on the provider. That's typically a case of pulling the contribution calculation details from the relevant payroll software on a monthly basis and then uploading that into the relevant pension providers portal, of which there are many, and then collection by direct debit. So it's a separate payment to the tax authorities and the student loan payments, which are remitted by the 22nd each month. Moving on from there, benefits in kind. If not obvious, what do we mean here? Well, we're talking about non-cash payments, remuneration, rewards to employees. So goods or services provided to an employee free of charge or at a greatly reduced cost. And there's a table in a second giving examples of the sorts of things we're talking about here. The general rule is that if you provide something to an employee, unless it's part of the specific arrangements as to how the value for tax purposes is arrived at, is that the tax value is the cost to the employer. So you spend X on an employee for something, that less any amount they repay for it is the amount on which that person is taxed. That's the basic rule. There are two broad categories of benefits. There are those which are provided specifically to an individual. It's very clear that it relates to an individual, for example, a company car. And then there's a need where benefits are provided to a spectrum of people in a business, lots of small amounts where it's difficult to attribute to any one individual. Those things are still taxable, and I'll go into that a little bit more detail in a minute. Those things are still taxable, and national insurance is still due on them, but it's almost impossible to do that by person. So what happens in those scenarios is the business itself enters into a PAYE settlement agreement, or PSA, does some calculations, and it pays it. I'll get to that in a second. So in terms of benefits in kind attributable to an individual, key things are those shown on this table. And there are more. Remember the basic rule: you provide anything as a consequence of employing somebody, it's taxable on that person. I've shared a few of the more common ones in there. So cars, still quite common, less common than they used to be. For a car, it's not the cost to the employer that becomes the taxable value. So it's added to the employee's income and the tax bands apply. It's driven by the CO2 emissions of the car. Every car has a formal CO2 emission figure. There's a table which is periodically changed by the tax authorities. That CO2 emissions figure turns into a percentage. That percentage is applied to the list price when new of the car. So even if it's a second-hand car which costs less than its list price, doesn't matter. For taxable benefit purposes, the list price when new. And that's added onto somebody's income for the purposes of calculating their tax. Point on that, electric cars, obviously, growing market, very important to get more and more of those going. Same principle applies, but the rates are very, very low. I think it's 2% now of the list price, fixed to April 25, whereas for fuel-based cars, petrol, diesel, and so on, even hybrids, it can be up to the high 20s or even 30% of the list price, which is a very heavy amount to pay. The other thing to know, as it says in brackets there against company car, is private use. If there's any private use, this applies. So people sometimes try and argue that their car was only used for business use. If there's any private use, this applies. Fuel, less people have that these days because that can catch people out. Again, because it's the similar basis to the car itself, it's a percentage of the car value applied to a fixed amount updated by the revenue each year to arrive at the taxable benefit. The danger there is somebody has their fuel provided by their employer. They do very few miles, but the benefit is fixed. It's a calculation based on the car. So they could be taxed on more than the cost of the fuel. They'd be better off by just not having it and paying themselves. PMI, another common benefit in the UK, medical insurance, nice and simple. The benefit, the amount on which the individual is taxed, is the cost of the employer of putting that in place. The premium, gym membership, similarly. Mobile phones, that causes confusion because if your employer provides you with a mobile phone, it's not a taxable benefit. However, if it's a personal contract between the employee and the phone company and they claim it back, that does become a taxable benefit. And you can see other things on there too. The other one I'll mention actually is interest-free loans. We see this with some of our clients. So a business will loan to an employee an amount of money, and they will charge interest lower than the market rate. So beneficial interest. In that scenario, if it's more than £10,000, they are taxed on the difference between the HMRC official rate for this purpose and the actual rate paid. And numerous other things as well. But I think that gives a flavour of some of the key areas that we're talking about here. So if we then move to PSAs again, I touched on this earlier. If we just flick to the next part, thanks, Nancy. Gets complex, this one. And I think the best example is talking about it in the context of things like staff entertainment. And that certainly applies here at Goodwille. We have a PSA in place for our team, because we like to take our people out sometimes and buy them a meal or buy them a drink. We can't carve that up and put it on somebody's tax return or P11D. It's just impossible. What we have to do is capture all of those relevant costs, analyze them. And there are exceptions. So for example, if it's deemed trivial, which typically means under £50 per head on average for any one particular event, so that could be a meal out, you dismiss it. If it's more than 50, it's in the mix for the calculation. So it's those sorts of small things that you can't attribute to a person. And as it shows there in red, it's for those broad three categories: minor, irregular, impractical. If it's contractual, doesn't count. That's taxable on the person because it's going to be regular. It has to be irregular. In terms of the process for a PSA, actually, before I go through that in terms of timings, we ourselves experience a number of our clients who don't realize they're spending on things that are relevant to this, don't have one in place. The danger there is There's a standard compliance visit by the tax authorities, by HMRC. They pick up on it. They do the calculations backwards. Fines and penalties kick in. Timings wise, if you move to the next section on there, please, Nancy. So the requirement for a PSA is apply by the 5th of July following the tax year to which you think you need one for. So for 23-24, apply by the 5th of July. Obviously, earlier is fine. Once you have it in place, though, it rolls forward year on year. It's there forevermore until you take it away. Key is, if you still have it in place and cease spending on the areas it covers, there is still a requirement to file it, and you can get into trouble if you don't, even if it's zero. In terms of timing of the filing, the return itself needs to be submitted by July following, and any tax and national insurance, because both apply, are paid by the 22nd of October following the tax year. So what in essence we're saying here is all of those costs are added up. They're treated as net pay, effectively. There's a gross up calculation as if tax for the tax that's effectively been deducted. That tax is then paid by the employer. And there's also national insurance at 13.8% on that gross value. That trips people up. This is kind of super simple in a way, excuse me. But if you look at the table here, at its most basic level, what is the cost of employing somebody in the UK? Well, first of all, it depends what you agree you're going to pay them on the basis of any bonus or commission, and indeed statutory pay. On top of that, from what we said previously, national insurance at 13.8% once they're running over 9,100 in most cases, the minimum pension contribution, and don't forget any benefits in kind. So that car that's costing them, they're being taxed on, there's also national insurance paid by the employer on that. They are broadly the categories, nothing else, that apply to the cost of somebody in the UK market. So back to the beginning on this, and where, excuse me, this has got more complex over the years, as I said. People get very confused about a number of things. So what do we see practically day to day? Somebody joins employment. The standard process in the UK is if they're employed by somebody else, there's a form or a document called a P45, which effectively takes how much they've earned so far in the tax year from that employment and is loaded into their new employment, because payroll taxes are calculated on a cumulative basis through the year. If that's not provided, nobody knows what the position is. The wrong tax code can be applied. And we see people actually being significantly undertaxed, but it comes up later and catches them out. They get a big tax bill. They don't like that. So that flow of information is important. Tax code is wrong. Same thing in a way. And we've seen a real example recently where a very highly paid individual has been on a base rate tax code, for whatever reason between him and the tax authorities, only paying 20% tax when he was well into the 45% band. Gets to the end of the year, because he was a high paid individual, he has to submit a tax return through self-assessment, and he receives a whopping tax bill. And I mean whopping. He didn't like that, but he should have dealt with that himself, or at least been aware that he was underpaying tax and put it to one side. Not registering for a PAYE scheme on time, but paying employees. If it's done reasonably quickly after the event, it's not a major problem, but we see people in a bit of a rush in our market moving to the UK. They hire, they haven't got a scheme in place, they need to pay their employee, so they estimate amounts, what the net tax, the net pay might look like, but the registration doesn't come through for many months afterwards. It can drift into a subsequent tax year even, and that can create real admin problems in getting it right. And time is money fixing things like that. Providing benefits without realizing sounds ridiculous, but be careful what you're spending on your people. Be competitive, be generous, that's fine, but be aware as to whether there are any tax consequences on the employer or the employee. So, for example, we've had businesses who have paid things like commutes to and from the workplace for their people, which can add up to a lot of money. Where if somebody's contractually employed to work in a certain place and then their employer pays their travel costs, that's a benefit in kind. Numerous other examples of that. Important to spot those early on. The last one's very different, and actually me speaking from the perspective of a payroll bureau servicing hundreds of clients in this space. But it's a really important example of where payroll can be perceived to have gone wrong, in speech marks. And that is clarity of comms and timing of comms. Payroll is ultra sensitive for obvious reasons. Everything manifests itself in the number, and that number hits employees, and they want it to be right, and employers want it to be right. So whilst a mistake, again in speech marks, might give rise to a numerical error which is small, it's sensitive, and that's amplified because of that sensitivity. And they're all things that we see on a regular basis. So I think for me, I think the takeaways from this are it can get complex when people have multiple sources of income or adjustments needed to previous years. It can get complex when benefit and kind are involved, particularly when there's a lack of clarity when they exist. And it can get complex when communication between employer and employee, and from our perspective as a bureau, from employer to payroll bureau provider, falls down. People aren't quite sure what's going on with the detail that then manifests itself on the employee, and people don't like it. So that's my overview of numerous points. There's a lot to consider there, but we're open to Q&A now, so please feel free to ask any questions.